Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today I'm going to be analyzing Nestle stock. I'm going to use the US ADR ticker NSRGY. So this will also be in US dollars. This one came in by request down in the comment section of one of my other videos. If you have a request, just put it down in the comments. I will get the ticker up on the chalkboard behind me and eventually I'll make a video for you. So Nestle is going to be interesting because I don't have a buy price on this one. As always, this is not individual stock advice. This is just how I analyze stocks. And I don't have a buy price on this one. I'm going to show you why, and I'm going to show you one of the reasons why I would have avoided this one and have avoided it for many years now. It probably might not be the reason that you think. So when we first look at Nestle on the fast graph, it doesn't look too bad. Like earnings have generally grown over the past 20 years that this chart shows. If we shrink this down to just this year and we go from 2004 to 2024, the earnings growth rate from point to point here is 5.64%. Now this isn't great, but I mean inflation was maybe 2% during this time. And so you get a little bit of growth, and so it's okay. I mean, the main reason I own stocks is because I want a financial asset that can raise prices to keep up with inflation. So one of the main benefits of owning a quality business is that you don't have to predict what future inflation is going to be. That's different than a fixed rate bond, where if you're a bondholder and you only yield 4% over the next 10 years or something, and inflation's 5% a year over the next 10 years, well, you lose money. Or maybe if it's 3%, you only make 1% a year in real terms. With a business, a stock, if it's a quality business, they can raise their prices if inflation spikes higher for some reason. And we just saw that with the pandemic with a lot of businesses where they were able to raise prices. So with that in mind, I really only buy stocks. Now, if it's a cyclical, these earnings can go up and down. So it's a little bit of a different story. I still want earnings to be rising over the long term. But I want this earnings growth rate to usually be over 5%, okay, is the minimum. Now, if we shrink this down to, let's go 2016 through next year, we'll look forward since this year's almost over. Okay, so now the earnings growth from point to point is 4.34% a year. That, and I'm going to say inflation during this time period is about 3%. So again, barely positive on this measurement. But the thing to remember is they've also bought back quite a fair amount of shares. They bought back about 16% of the shares outstanding. So that inflates this earnings per share, because when the share count goes down, it makes the earnings per share go up. So this real earnings growth rate is actually lower than 4.3%. When I make that adjustment, I get, let's see if I can, I think it was 2.58%. Yeah, so 2.58%. So now that is, over that period, about the same as inflation, or maybe slightly under it. We'll just call it the same because these are just estimates. We can also look at the 3-year revenue growth. So this is cumulative. How much has revenues grown over 3 years? That's at 7.82%, which is very much in line with what we see here on the long-term earnings growth. So basically, for a long time, this business has only really grown earnings at about the rate of inflation or slightly faster than that. So it's kind of right on the borderline there. And for me, that's not good enough for me to put a buy price in, because I already said that I want the business to be growing over the long term and preferably faster than inflation. And while they're doing that so far, what happens when, let's go here next. So this is a little chart I made. I show sometimes that I call the business life cycle, and you can find this at other places, but I just made my own version of this with my own strategies on it. So normally with a public business, we have this pre-IPO time where they're losing money, but maybe gaining customers. And eventually, when it looks like they might eventually make money, they have an IPO, they go public, and eventually they start earning real money. This is the successful ones, the ones that don't fail. And then you get to kind of this pretty fast profitable growth stage where earnings growth is growing faster than 15% a year. Now this would have been happened for Nestle like 50 years ago or like 100 years ago, something a long, long time ago, right? And then the steady growth phase would have been the last like 30, 40 years or something like that. But by the time we get to like the mid 2000s, I mean, as I showed, I mean, earnings growth is growing, but not very fast. And we start getting into this kind of danger zone here when we have a mature, low growth business. And now earnings growth has started to tip down a little bit. And there's always like a confluence of reasons that are happening for why that might happen. But we have a long enough period that has been slow that we understand that. But the problem is, once those earnings growth starts turning negative, then the market usually starts extrapolating out this toward the future. And that's what's happened to the stock price partially. Now, that graph there doesn't take into account valuations, right? So, but if we look at the valuation of Nestle over this time period, it averaged about a 23 PE most of this time. And at the peak, it was a 29 PE. And right here at the beginning of the end of 2019 is a 26 PE. So when you consider they're only growing slightly faster than inflation, we could call it 5% here if we want to, 4%, 5%. To have a mid-20s PE is pretty ridiculous. Like the investors that did this, that paid that much, didn't understand the dangers of paying a high valuation for a low growth stock. And the cost of that is from the peak down to where we are now, that investor's down over 40%. And from somebody that bought back in 10 years ago, with inflation, they've earned no money. So I was curious because I've written lots of articles on stocks like Nestle. I don't think I've ever written one specifically on Nestle. But I see this mistake was made a lot during this time period with a lot of staple companies. Let's see what we want next here. So I went and asked AI this question about, during the years 2015 through 21, what reasons did investors cite for buying and owning Nestle stock? And so here's what came back, and I want to comment on this because I think it's pretty accurate, since I've been doing this since 2015, so during this time period, and I got to see this firsthand from the people responding to like my articles and things. So the number one reason was a strong global brand and market leadership. Well, that's good, but when you're a mature business, that's not necessarily good because there's no other place for you to expand. And as we've seen with the deglobalization that's starting to happen, it actually makes your business more fragile because you're exposed to more geopolitical problems around the world, transporting your goods around the world, and just generally being involved in business in all different kinds of places. So I think it's a mistake when I just don't see that as like a benefit for a stock investor. Now, having a strong brand is okay, but the fact that it's already global and already big and already mature, that's not good. And that's why you don't pay a 25 PE for a business that's not growing when you could go buy Alphabet or Facebook or Microsoft for the same PE during this time period. I mean, so that's not a good reason. The next one, stable and growing dividends. This is a bad reason too. One, the dividend yield on this was 1 or 2% or something like that during this time period. And I don't want to say never because there are occasionally time periods where you can buy like a stock for the dividend and it can pay you back quickly enough that you can earn your money back before the business slows down over time, right? If the slowness, let's just say Nestle declines slowly over the next 20 years, right? If the dividend was 8%, you could earn your money back 2 or 3 times during that time period still. But the problem is the yield was so low that it just didn't justify that. I would also say they should have been paying a higher dividend as a mature company rather than buying back their shares. So that was a misallocation of capital, and most of these businesses do it. But when I see a slow growing business and they're buying back their shares, to me, that's not shareholder friendly. They'll say it is, but it's not, because if they give the money to you in a dividend, you can go spend that money and buy a faster growing business. Rather than putting it back into a dying business, right? Without your choice. So there are efficiency reasons and why they like to do that, and also executive payment, but that's not a good reason to own Nestle or any of these consumer staples when they yield 2%. They should yield 7% before they get interesting, right? Okay, so resilience and defensive. Well, it hasn't been very defensive, right? The problem is they're not defensive when they yield, when the PE ratio is 30 or 29. A lot of people will talk about, let me see if I can, let's go back in here real quick. I'm just going to look. A lot of people make this mistake, and they do it with Walmart. I've seen them do it with like McDonald's especially. Okay, so the PE going into the Great Recession was 20. Much lower than what it was during the past 10 years. And the stock still lost, let's see, I don't know what it's going to be. Fast graphs is useful for this. So the stock still lost 40% during the Great Recession, give or take. It went in with a 20 PE, right? If it goes in with a 30 PE during that time, or a 29, well, let's see where it bottomed real quick. It bottomed at like a 12 PE. We aren't even there yet. That'd be another like 20% down or something like that. So it's well, for one, it was slightly more defensive than the S&P 500, which fell like 50% or 55%. So it was a little bit more defensive, but it only had a 20 PE going in, not a 25, 26, 27, right? McDonald's is a really good one to look at, because in 2000 it fell 80%, and let's just look at it really quick while I'm on my rant here. So, and people look back at the Great Recession here and they say, oh, it was so defensive, and again, it had a 20 PE going in and it never fell. It grew earnings throughout it. It fell down to like a 14 PE, mostly from earnings growth. So yeah, it was very defensive. It didn't fall hardly at all. But that was because it was cheap and it had just come off an 80% decline from 2000, right? So now we have had a 20 going into that. Again, it has a 20. By the way, it had like 30 and 20% earnings growth going in too. So let's call it a 25 PE this time around. So let's turn it into a McDonald's one, but that's okay. So we have 38%, 6, 16, 26, basically 20% earnings growth going into the Great Recession with a 20 PE. That's a peg of 1. Now it has like no earnings growth, basically, and a peak PE of 25, right? It's just not going to do as well. And so Nestle's pretty similar to that. When only investors have already found it out with Nestle. So just because it's consumer staple doesn't mean it's defensive, because if you pay too high of a valuation, this Nestle really should be like a 15. It should be where it's at now with earnings growing 5%. This is where it should have been. Should have never got above this. So, it's off its high, but as I showed in the spreadsheet, or if I haven't gotten to the spreadsheet yet, I think I did. The 10-year CAGR earnings expectation is like 4 or 5%. Like, it's not any cheaper than the S&P 500 right now, because the earnings growth is so slow that a 15 PE isn't cheap, right? You could go back here and it traded at a 15 PE around all-time highs or close to it, right? 16, 17 PE. So let's look at some of these other reasons. All right. So it's not resilient. Dividends don't matter. The global reach was a negative. Innovation and health trends. So this is actually, I think, pretty good. But the problem is that they're such a big company that, those type of changes really just help them maintain their like their earnings, rather than really grow them a lot. If you think about it, they're probably cannibalizing part of their other less healthy business with the new healthy stuff. And it's just so much easier for smaller companies to come out with their niche health products all the time and market them, especially with the internet now. There's a lot of competition there. So I think 4 is probably good, but it's more of a maintenance thing than a growth thing. Sustainability and ESG, right? I mean, this has become just a total 180 basically from a few years ago. And I don't really think investors should. It's fine not to invest in some company you think is really doing harm, right? But if you're trying to make money, usually putting ESG like at the top of the list is not like of your priorities is not such a great thing. And the problem is like a lot of these in like finance investing company, like BlackRock or whatever, who is pushing some of this stuff. Really what they're doing is they're creating new ETF categories so they can collect fees on people. It's more about them just creating different reasons for people to buy higher fee ETFs and mutual funds and whatever. So rather than it being like a real thing that people like really cared a lot about. And so I think that this is just marketing from the big financial companies. And then 6 is emerging market growth. Well, this is a lot like the health thing. The emerging markets usually don't have very much money. So if you have a developed market company selling pretty expensive products, it's really hard for them to go into enough emerging markets to make a dent in their bigger earnings picture. So again, it's more of a maintenance thing and a long term. I mean, it's good to expand, right? But in terms of it actually reaching the bottom line, that's more of just a story that's being told than actual, like there's just not as much money to be made in, I won't pick on any country, but in a poor country than in a wealthy country. That's just how it is. And so now over the long term, those positions change. So you want to sell your, Coca-Cola wants to be everywhere, right? That's totally understandable. But they're not making as much money in a poor country of the same number of people as they are in a wealthier country. So just something to keep in mind there. So I think this was good to look at. I thought it was interesting just because it can be applied to a lot of stocks, other stocks that are just like Nestle. And the key is almost always just don't pay too much for them. Now, in terms of buying today, in the right conditions, like if these actual conditions played out, the analysts think, where they get 7% growth in 2026, 9% in 2027, and there's not a bunch of inflation that's the reason for it, the stock could go up 30 to 50%. But the problem is we don't know if that's really going to happen. We also don't know how bad 2025 is going to be. We don't know how long like that earnings recovery is going to take. And so I don't personally invest in turnarounds like this. Now, maybe if you saw it happening and the momentum in the stock changed and you looked and there was maybe if you thought a 20 PE was possible and it was at a 15, you can get a 30% return. A person could try to do that if they wanted to. But I don't like sitting around waiting for a slowly shrinking company to find a way to grow again. So it's just not really my type of investment that I'm looking for. But if earnings did pick up, or if there was a huge drop and it fell another 50%, that might get overdone enough for me to buy on an upswing if they started to come out of it. But I think this is one you want to buy on the way out if you're thinking about it when there's a little bit more proof there, rather than trying to pick a bottom on the way down. Because it can just, even if this is the bottom, it might be the same for 3 years, so it might not go anywhere. Usually if I'm buying on the way down, it's with a cyclical business that's going to come back quickly, right? Not a giant global consumer stable company. Okay, if you found this useful, hit the subscribe and like button. If you have a request, put it down in the comments section. I have a weekly picks over on Patreon for $25 a month. Check out that link. There's a free tier on Patreon too, where I post all these same videos if you don't want to rely on the YouTube algorithm to get my videos in front of you. And I'll see everybody later.